Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 2, episode 53. So, what that means is part 6 now on the multifamily case study we've been doing on income properties as our general topic umbrella or the strategy, if you will. And so, in the last episode, we actually went over basically wrapping up the last 3 episodes as a giant scenario as well. So, what we did there was we raised the revenue on the building. And as a result, NOI went up because we fixed for demonstration purposes expenses at the same level. However, today you're going to see that some tweaks probably would have been needed, but to demonstrate the principle and the concept, we basically fixed it. At the same time, though, we're going to go into further detail today as well. But what that really means is NOI went up to $58,005.92, resulting in a new cap rate of 8.01 on the building, as opposed to the 5.78% buying the property as is. And what that means is if we actually take the 5.78% cap rate as what the lender's standard market cap rate in that area or in that market where the building is located, then there is a new value based on performance of just a bit over $1 million. In fact, $1 million, $3,562.60 to be exact. And so what that means is we did a hypothetical money left in a deal of $35,000, and then you would actually be cash flowing just a bit over $2,000 at that point. So that's based on the original numbers. So this is why, I don't want to focus too much at the moment on cash flow yet either, just because there are still a few details to be tweaked. But hopefully, as we chop it down by sections, you sort of get the thought process, okay? Even though the numbers are not 100% accurate or reflective of the overall change, but the purpose of chopping it down section by section, factors by factors, is to show you how when one number changes, what some of the other numbers that are impacted would change as well. So today we're going to go into, last time we talked about increasing revenue. What if today we talked about decreasing expenses? And just on this note though, I'm just going to tell you, because this is really the same thing as whenever somebody wants to get into better shape physically, they're going to start to say, I'm going to cut this, I'm going to cut that out, I'm going to cut that out. Yes, that takes a lot of effort. And on a personal level, you probably can't do that, especially if you're somebody who likes to drink soda, eat a lot of chips and chocolate and junk food and put all that in your body. However, when it comes to a building, I think if you've had certain amount of life experiences now, it's definitely one of those things where it's easier said than done, because when it comes to owning and operating a building as your asset that's generating income for you, increasing revenue is a lot easier than decreasing expenses, because most expenses really are out of your control, most of it. And so this is why we focus a lot more on usually training on finding revenue generating opportunities. And really, on a personal level, when it comes to our financial situation, yes, I understand being physically and financially responsible, meaning it might be good for us to create and stick to a certain level of budget. However, at the same time, to me, that's more of a short-term solution, because in the long term, having a budget and always having to stick to it can be really soul-crushing and make life really boring at times. And this is why we always find different ways to increase our revenue, so that we're not always choked up by the budget that we have set out for ourselves. So that being said, though, when it comes to expenses on using this property example as our case study, then remember, under the expense column, again, I have it all here, which you guys can go back. And I believe this was part of part 1, actually. So season 2, episode 48, you can go back and refer to these numbers. So taxes, the expenses were given. I'm not going to go down to details now. However, taxes were given, insurance was given, water and sewage, power and gas, garbage collection, snow removal, lawn care, property management, maintenance, vacancy, repairs. So those are the numbers that we are factoring in to our entire calculations right now, okay? And so what this means is, what if we can decrease expenses? So let's go over some of those categories once again here, and I'm going to change color. So taxes. Can we change taxes? The answer is actually yes, we can. However, do we always want to? The answer is it depends. This, we have a lot less say, being that it's a multi-family building as opposed to a single family unit, which we're going to cover as a separate case study, leveraging single family properties as our example. But today we're still on part 6 of the multifamily case study right now. So from a taxes standpoint, it's a lot harder for us to change, first of all. Second of all, taxes tend to go up and not down. So if right now we're at 17,230, chances are this is either going to stay the same or go up, okay? Now, next, insurance, same idea. We have 4150. You might be able to shop around. However, remember, when it comes to insurances, make sure that the coverages of the policy that you are looking at are apples to apples, because I've come across so many different investors just because they want to save $20, $30 on a monthly basis, meaning they're hoping to create $20, $30 in extra cash flow, then they end up foregoing the proper coverage that their building actually needs. And they don't really learn about it until something actually goes sideways. And so in my opinion, this is also one of those things where it stays stagnant or it actually goes up. Cost of insurance has been known to go up quite substantially, especially when it comes to commercial grade buildings. So at 14 units, definitely consider commercial grade, okay? And then water and sewage. So depending on the municipality, the market, the city, the town that this property is located in, right now we have 9408 as our number. This, you can actually go down, maybe stays the same if you hang on to the bill, or again, depending on how much the city is raising the rates on these services or your service provider, it could go in 3 different directions as well. However, the fact that there is a possibility for it to go down, we like. And how and when does that happen? Well, the most popular option is if and when you can pass on that particular of the utility bills onto your tenants. So that's usually when you're able to drive that bill down, or once again, depending on the market that this property is located in when it comes to water and sewage treatment as well. So for example, I know on the west coast of Canada, because in British Columbia, where the major city is Vancouver, a lot of people have heard of where Vancouver is, they have a government entity called BC Hydro, and that actually helps with their water, sewage, all those kind of bills as well. Whereas being in Alberta, everything is regulated, however privatized. So what that means is our rates, while on paper seem competitive, they are actually fairly high because they're all private independent providers. And so when you can actually pass that on to your tenants, you can drive that down. So in Alberta, a lot of times you are able to pass that on. However, when you want to do that, you also usually need to make sure that each unit needs to become separately metered. So when you first are acquiring this building, if it's not already individually metered, then that's probably one of the things that you need to find out when you're doing your due diligence. That way it will allow you to run a deal analysis like this to factor in decreasing the expense that you need to incur as the owner on title, or as the holder of the property, or as the controller of the property, to drive down your water and sewage bills, okay? And so with that being said, we also have power, gas, garbage, So these would technically fall under, I'm gonna use this, all these items, the same rationale that I just provided would a lot of the times apply to all these different expense categories, okay? So go down and then go up. Gas was 16,328, go down, remain the same or go up, and then 1,600. Oops. Go down, maintain the same, go up. Just depends on how you negotiate and what your provider is and whether or not you're in a market where that's even a possibility, okay? Here we have it. And so with that said, we had, I'm just gonna speed this up now. So the other categories that we had were snow removals and lawn maintenance. Oopsie, with an N at the end there. We had 900 for the year, so $75 a month on a contract. And then we have management. So management, in my opinion, is another one where there's some potential, especially when you start to scale up in the same market and you have the same property management company that is helping you manage all of your units in that market as well. So because they're scale, they're more inclined to give you a discount, if you will. So originally we used 8% as our monthly property management fee. So 8%, remember, I think I reminded everybody of this as well, is one of the expenses that a lot of people tend to forget is that whatever management fee that you need to pay, you also need to tag on the sales tax in your province, in your state, in your city, in your country, okay? So before we used 8%, but 8% needed to add something else to it, which are taxes. So let's just say that assuming you either find another property management company that'll give you maybe say 6% as opposed to 8%, or the fact that maybe a year from now you've actually got picked up a couple more properties like this. So that means you got scale now, and the property management company that you're working with that you started out at 8% with is happy to offer you a lower rate because you're giving them more business. So overall, there's more volume for them as well. So the economy of scale is there for them too. So it makes sense, okay, in that particular story. So remember, this is the part where we probably needed to do some adjustment because the management fee is done on revenue collected. So really, in our last episode, when we said we fixed the expenses at the same amount, that is an iffy point there, but it shouldn't be that big of a change. I really just wanted to demonstrate one point at a time. So we fixed a lot of the other factors constant, but now we're gonna bring this part back in. So if our new revenue, okay, if our new revenue basically turned into 142,320, that's what we said. Just realized I forgot to write it out. So new revenue, I'm gonna write it out here, is 142,320. So as 6% management fee, okay, and I'm just gonna say, let's say if this property is located, whoops, I don't want that color for expenses. So I'm gonna go back. So what that means is it's gonna be 8,539.2. That's 6%, and then times if this property is located in the province of Ontario, for example. Ontario has what we call HST at 13%, so it'll be multiply 1.13. So that means 9,649.3. So that number actually went up a little, okay? Actually, funny enough, that number actually went down a little based on our first example, because our first example here worked out to be $10,594.08, okay? So that worked out in our favor. And then vacancy, we budgeted at 5%, and then maintenance and repair, we budgeted at 5% as well. So once again, if the new revenue is 142,320, 5% here would work out to be 7,116. So 7,116. Okay, so what we've done here now is we've managed to find money here, assuming that we're in an area where we can negotiate with a utility service provider that offers a bundle deal that will cover your water, your sewage, your power, your gas. Power means electricity, and your garbage, for example. And we've also managed to negotiate with the property manager to say, hey, can we go down to 6%? Let's add everything up now, okay? So when we say going down, I'm just gonna do a ballpark here again, just for the sake of demonstrating what that would mean. So let's add everything up first. So 9408 plus 11492, I'm referring to the numbers in the box that I have there, 16328 and 1600. Okay, so all four of these items currently is sitting at 38,828. I'm gonna write it down. So this box is sitting at 38,828. How about we said, we're not gonna be too crazy. We just managed to save, let's just say about $100 on a monthly basis. How's that? Let's not go crazy, because if you've been following my Daily Dose with Tim, you understand I keep saying underestimate revenues and overestimate expenses. So even though we're cutting expenses, we're not gonna cut a whole lot, okay? So $100 on a monthly basis means $1,200 a year. So that means our new number is 37,628. Okay, 37,628, and our new management amount is that. So let's take a look at what the total new expenses will look like. So you can see, I honestly love the very grassroots approach when it comes to running numbers, which is pen and paper. So we have taxes, we don't change that, 17,230. Insurance, we're not gonna change that. I mean, for some of you, if you wanna raise that even, go for it. But for demonstration's sake, right now, we're not going to, okay? Because what we're focusing on is just bring the expenses down a tiny bit at the same time. So meaning now we're piggybacking on to what we did the last couple of in the last couple of episodes, which is driving up revenue and decreasing the revenue by a tiny bit. So plus the new 37,628 there, and then plus 900 plus 9,649.3. This is with the 13% tax, okay? I'm gonna write this down. So plus 13% tax. That's what gave us that number, plus 7,116 for 5% vacancy, plus 7,116 for 5% maintenance and repair. Again, if there are other categories you want to add in there, I just want to compare apples to apples for everybody. But if you wanted to add other things in there, which we normally would, then go for it, okay? But without diluting the deal example or the case study example now, we're going to keep the numbers relatively the same in terms of the different expense categories. We're not going to add to it now, last minute, okay? So what that means is we have a total new expenses of 83,789.3. So funny enough, overall, it actually went down because the original expenses came to 84,314.08. So really now, the new NOI, okay, let's take 142,320. The new NOI really is 142,320 minus the new total expenses, which is 83789.3. And then what we have is 83789.3. We have our new NOI. So I wrote it down twice, I guess. That's how much I like it. 58,530.70. So it actually went a little bit better than that, which means our actual new cap is 58,530.7 divided by the original purchase price of 724, which is 8.1, but it's really 8.08435. But it's better than the 8.01 once again, okay? So remember, the point of figuring this out is to really figure out how much the property is now worth now that we've gone through what we call the stabilization period. The stabilization period means that we've stabilized the NOI, meaning the building performance. And the building performance is determined by two factors, revenue as well as expenses. And this is also why, I think I've mentioned this already, we teach a class that's not called property management, but really tenant management and property management, because when it comes to revenue management, it has a lot more to do with tenant management, starting with advertising, the tenant acquisition and tenant screening period, because they are the people that are actually going to be paying you rent. And then on the property management side, it caters a lot more to monitoring the expenses part, because that has a lot to do with how you manage the performance of that piece of hard asset and the maintenance costs that come with it. And in this particular case, when I say maintenance costs, it's not the same as maintenance repair budget. Your maintenance costs would be your taxes and insurance and water and sewage and power utility bills and all that kind of stuff added up together, okay? Meaning really the number should represent the efficiency in which you're operating or managing that particular piece of asset. Whew, that was a lot. So what that means now is let's take a look at what the new value is. Okay, so the new value, if we're going to use 58,000, okay, 58,530.7. Remember now, using the new NOI divided by the old cap rate, because that's what the lenders have deemed the market cap rate can be and is for that building. So in this particular case, instead of 1,003,000 something, I believe we said it was 1,003,562.6 from the last episode. Right now, it is 1,012,641.8. So we've raised the value further more as well. And so what that means now is we've gone through our stabilization period. The next step is to see how we can be slightly creative with putting the deals together and maybe even paying some investors out if that's one of the things that you want to do, or really taking care of your joint venture partner so that you can do more deals together. So with that said, thank you for joining me again on this particular episode, which is season 2, episode 53. We're coming up near the end of season 2 now, and this was part 6 of a multifamily case study under the strategy of income properties. So I will see you back here at the next episode, and thank you so much for joining me again. I will see you, and live well, everybody.